Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, February 8th, 2022. Welcome back to the podcast, George.
Great to be back on, John.
Always great to have you. So, George, the rates market continues to be on the move. It seems like never a dull moment since we turned the calendar into 2022. There have been a number of key developments since we had you on the podcast ahead of the January FOMC meeting. Why don't we start things off with you updating our listeners on the drivers of rates markets over the past few weeks?
Absolutely. It's been a never-ending move for sure. And there's clearly a fear of the Fed having to tighten more, but now we're also seeing an equally kind of concerning fear amongst rates investors about the idea that we're moving away from a negative rate world, or a world where other central banks have been keeping their rates for such a long period of time at or underneath the zero bound, especially the ECB as well as the BOJ. Now we have a much more hawkish Bank of England. I think in general, there's this kind of concern out there that we're moving away from this super low rate environment, which was not just specific to Fed policy, but a function of global central banks in general. So I think that this combination of what we got post the Fed meeting when it was the last time I was on, till now, and of course some data developments along the way, especially the jobs report, we are clearly in a mode where investors are very defensive and moving to pricing in further hikes. I think we've kind of characterized it as like there's a race to see who prices in more hikes or forecasts more hikes around the concerns of what lies ahead for future Fed policy. But I would say that the biggest development is this hawkish synchronization of hawkish developments at the central bank level, not just in the U.S., which is now really causing a concern amongst fixed income investors. If you recall, from 2014, basically till now, because the ECB still has negative rate policy, and Bank of Japan has been in a negative rate environment for such a long time as well, once they launched their QQE, that this negative rate environment has led to the U.S. bond market, benefiting and seeing lots of capital flow, both from Asia as well as Europe into the U.S. fixed income market, which has led to what we call the conundrum 2.0. The first conundrum was back in 2004, 2006, and then from 2014 through basically 2017, even as the Fed was trying to adjust policy, overall long-term rates stayed very low. And so if that's truly unwinding, if we're going to see central banks outside the U.S. also start to raise rates, that will be another pressure point for our markets.
Yeah, that's a great point. I mean, it seems like the sell-off's kind of been pushed from a variety of different angles. You have boons in positive territory. They've actually sold off more than 10-year JGBs, which is pretty incredible. So let's see, as a reminder to our listeners, we are recording this podcast right in the middle of the February Treasury refunding auction process. In addition, this week's CPI could very well be a make or break moment for the sell-off as the 10-year approaches 2%. So George, I guess the question is, how are you thinking about the coming days? And once we make it through the refunding, once we make it through CPI, what lies ahead for investors and markets?
Let's take a step back before we get into the forward-looking comments. Let's think about what this week means as well. We're at some really critical levels, as you suggest. The psychological 2% level on the 10-year has not been broken yet at the time of recording, but we're very close to that level. And in fact, this 194, 197 level on the 10-year is a point where there's really no real clear direction of what happens next. This is levels that we had seen at the midway and towards the latter part of 2019. And so, if we do break through, which I think we will, I'm not sure if this is the week that it happens, but once we do break through that, I think it's going to open up other possibilities on the charts to much higher levels, which I'll get to in a moment. But the auctions, whenever we see new auctions like the refunding auctions, which happen every quarter during February, May, August, and November, if we're in an environment of rising rates and close to the top of the channel, which we are now for the local regime of the highest rates we've seen in quite some time, that typically does draw in value investors. We saw a pretty healthy, one of the strongest 3-year auctions where the 3-year auction basically close to 1.6%. It wasn't too long ago, basically 2 months ago, where the 10-year was struggling to be 1.6%. So we've definitely priced in a lot of hikes as well as higher rates across the curve. And so now with the 10-year auction still ahead of the 30-year auction, nestled between the CPI development, I think that this will be the most crucial week for the month, and it will set us up for the actual Fed meeting in March when we think they're going to hike rates. So I think that this is so important to see how things unfold. If we get strong demand at these higher yield levels for these auctions, and CPI manages not to surprise to the upside, this could then mark the local highs for rates, and we can rally back down. Probably not all the way because we still have the Fed ahead of us, but maybe 10 basis points kind of rally is definitely doable. Conversely, if CPI does surprise to the upside and we see a more broadening out of inflation pressures and that the core inflation is staying sticky or actually starting to lead the charge to higher inflation, then there's that risk that we're going to break that 2% and that these auctions end up being a failed support along the way. So that's like in the here and now. Once we get past this week, and we'll see how those two scenarios, which ones play out, and then we really get into it. February being a short month in terms of days. We have the NFP before the Fed, and I'm sure I'll be on the podcast before the next the next Fed meeting. But I do think that this is a super critical week to define the upper boundaries, and if we can't hold at either 2%, then the move from there opens up an opportunity towards 2.125 and even 2.25. Just to make life simple, 2.1 to 2.3 could very well be where we get this final blow off move in intermediate and belly rates, where convexity paying and some of the hedging, which has been lacking along the way, you see investors push up rates in this final move right ahead of the Fed meeting. So that's the boundaries that I'm looking for. If we stay under 2, then we're due for a minor rally if CPI is not stronger than expected or higher than expected. If not, and we start to make a run towards that, it could mark the highs for the near term and make a run towards well above 2%. And then at that point, it's going to be interesting to see how the Fed communicates. But we'll cross that bridge when we get there.
Yeah, that seems like two pretty good bookends to kind of approach the coming week and the coming weeks. You had an interesting chart in your weekly about price action around refunding, where if you can kind of form a bottom in the market, that can serve to have rates bounce. So I'd certainly encourage our listeners to check that out. And if you aren't receiving George's strategy reports directly, please feel free to get in contact directly with either me or George via email, Bloomberg, or otherwise. So George, great stuff as always. Thanks again for joining us.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.